Lowe's moving to the downside, off about 1.5% after topping first quarter earnings expectations and reaffirming the full year forecast. The home improvement retailer CEO saying investments in tech and inviting store environments helped offset near-term uncertainty and housing market headwinds. Joining us now, Scott Mushkin, R5 Capital founder and CEO. And you have a sell rating and a $220 price target on Lowe's. Talk me through the price action this morning, because originally we saw a little bit of a move to the upside off of this earnings print that was better than feared. And now we're seeing this move to the downside following the call. What did investors hear that they didn't like?
I mean, I don't think they heard necessarily on the call anything they didn't like. I mean, I think the business is kind of stuck in neutral. I think the concern really, if you look at that 10-year bond, I mean, it's housing is, again, kind of stuck. And without housing getting a move on, it's kind of hard for Lowe's to have good results. Same thing for Home Depot. I mean, both companies are managing well, given what's going on with the consumer, and in housing. But without the rates coming down, I think it's very hard for people to get excited about these stocks.
Yeah, that's. Oh, sorry, Scott. Go ahead.
Well, I was just going to say, then of course you have the tariff background, the potential of recession. I mean, there's a lot of overhang here.
Yeah, and it's a great framework because it points to the fact that not a lot of this is necessarily in the executive suite's control. Is the bond market the key indicator for the share price of Lowe's going forward?
I think it's a big indicator, but I'd also say macro, besides the bonds matter a lot. The other thing I would note during this earnings season, which our research and consulting business would actually disagree. We have a large consulting business. We actually think there has been pull forward of demand. So when you look at the results by a month, and Home Depot did better, Lowe's did a little bit better in April. You gotta, I think, look at that with the idea some consumers were purchasing in anticipation of tariffs. So I think what our concern in the C-suite is they're maybe underestimating that, and that goes even for like Target, which is having a huge down day today. That we do feel like there was pull forward in demand.
And my guest host Brian Levitt has a question for you, Scott.
Hey, Scott, if you look beyond just the near term, obviously the move in rates and the tariff uncertainty, you think about the fundamentals. Is this a country where the fundamentals still look positive in terms of the demographic mix, in terms of the housing supply and the housing investment that'll have to happen over the next number of years?
Yeah, that's something we actually wrote to this weekend to our clients. One of the things as you look at, we called it, it's been a heck of a good 30 years in retail. Part of what's happened with the offshoring is you've had a lot of deflation in goods. That spurred tremendous demand, and you almost say over demand. As we unwind some of that, you wonder where consumers are going to channel their spending. I mean, if you look at growth in durables as a percentage of consumption, of real consumption, it grew from 5.5% 30 years ago to 13% today. I don't know if it goes down from here, but it's hard to understand if it goes up. So this is a really good question about retailers generally speaking. I mean, if you look at Target, which we talked about, there's been an insane amount of growth in some of their core categories over the last 20 years or so. You wonder what's going to happen in the backdrop where you have an administration saying, hey, we need to reshore. Maybe we don't need 20 pencils, we can get away with 3. I think the dynamic on retail over time is not nearly as constructive as it was, say, 15 years ago or even 5 years ago. So it's an excellent question, something we've been talking to our clients a lot about.
It makes me wonder then, Scott, what is the headline story of the American consumer's response to tariffs to come out of this earnings season thus far when it comes to those retailers?
I think the headline coming out is kind of status quo. We haven't really seen the impact of tariffs. We haven't seen the consumer moving much of their spending except the pull forward I mentioned. I think as we get into the summer and into kind of the back half of the year, and then of course we have the big beautiful bill, some tax changes. Also, I would just emphasize, watch those bond yields. Bond vigilantes was a big term back again 30 years ago. We have a lot of debt, and people got nervous about that about 3 or 4 weeks ago. So definitely watch the tax bill. Definitely watch the bond yields, and then unemployment. That means the most. So I think right now it's fine. Maybe not great, pull forward, but I think the next 6 months are going to be very telling how things break for probably the next 18 months.
Scott, will it look different to me and to consumers when we walk into these stores? I mean, you hear these stories about empty shelves. You hear some people even warning about long-term stagflation, which I certainly wouldn't be in that camp. But empty shelves and price shocks, is that what's in our future over the next months?
You know, as I mentioned, we have a consulting business. If you look at a retailer, a good retailer, they call it facing over. So what they try to do is fill in those shelves so you don't really see a lot of missing product. And there may be some of that facing over as it gets harder to get certain items. But I guess to the idea I have, and I agree with you about, are we going to be massive inflationary with a tariff shock? I mean, basically, if you step back, we look at the tariffs being implemented as a import consumption tax. We run 7% budget deficits here in the U.S. Our belief is you can't continue that, and we're not alone in that. They need to raise money. They have to figure that out. One way is tariffs. What that will do is basically kind of bias things away from goods, make them more expensive relative to services. Reshoring will also likely do the same thing.
Right.
So we're trying to understand where that money gets channeled as we continue to grow. We may have a recession here, but eventually we'll come out. And where is the consumer going to channel that spending? Consumer services are interesting to us.
Scott, so sorry, we have to wrap up, but thank you so much for making the time for us. And Brian, thank you for joining the conversation as well. Really appreciate it.